RBI has recently come up with draft guidelines on ECL framework. This framework is going to replace IRAC norms, which is in prevalence since 1993. As per the guidelines, ECL framework will commence from 1st April 2027 and after 4-year transition period, full implementation will be by 31st March 2031.
Provision under IRAC was simple. Outstanding multiplied by IRAC provided rates. Both were known. However, under ECL, this is replaced by elegant formula where ECL equals EAD multiplied by LGD multiplied by PD. And interestingly, all of this are dynamic in nature and keep on evolving over time. During the course of video, we'll try to find out various things such as relationship between IRAC and ECL, staging, EIR, PD, computation methodology, what is lifetime ECL, how it is different from 12-month ECL, what are provisioning floors under ECL, overall how much difference does this bring to table, how will this impact capital adequacy of a bank. To sum up, ECL replaces static provisioning with forward-looking risk measures, wherein each component evolves dynamically over time. The transition from traditional IRAC framework to the expected credit loss model marks a major evolution in prudential provisioning. Under the IRAC method, banks applied fixed rates to set classes such as standard and substandard accounts, which made provisioning static and backward-looking. The expected credit loss framework introduces a forward-looking design. It decomposes total provision into Stage 1, Stage 2 and Stage 3, each representing increasing risk of default. This dynamic structure allows provisions to self-adjust as credit conditions change. Let us now understand how time-based classification evolves under the old IRAC framework and the new expected credit loss model. We'll map how time buckets change from a standard to stressed asset stages. From the start at time 0 up to 30 days from the due date, the asset remains standard and general provision is maintained. This period aligns with Stage 1 under ECL, low credit risk, with no significant deterioration observed. Between 30 and 90 days past due, the borrower has missed payments, but the loan is not yet classified as non-performing. Under IRAC, the provision remains general. However, under ECL, this falls under Stage 2, a phase that captures significant increase in credit risk before default occurs. After 90 days past due, the asset becomes non-performing under IRAC. This is covered by a specific provision, which corresponds to Stage 3 in ECL, full recognition of credit loss. In summary, while IRAC provisions are triggered after default, the ECL model acts earlier, recognizing credit deterioration as soon as it emerges. This shift makes provisioning forward-looking and responsive to early warning signals. Let us understand the concept of effective interest rate, or EIR. It reflects the true cost of lending after accounting of timing of cash flows, fees, charges, and commissions. EIR is not always the same as nominal interest rate printed on the loan agreement. The nominal interest rate is embedded within the EMI formula. It represents the discount rate that equates all future EMIs to the present value of the loan disbursement. Over time, the carrying value of loan decreases as installments are paid. At any point, the carrying value equals the present value of all remaining EMIs, discounted using the effective interest rate. This can also be expressed as loan start value minus amortization equals the discounted present value of all future cash flows. That is the mathematical foundation of the effective interest method. Hence, we can express the relationship more precisely. The loan value minus amortization equals the present value of all future payments discounted at the effective interest rate. According to RBI guidelines, EIR must include all fees, charges, commissions. Hence, the actual effective rate may differ from the nominal rate. To conclude, the effective interest rate represents the true yield on a financial asset or the true cost of a liability. It ensures that income recognition follows the timing and value of cash flows over the life of the instrument. This is a simplistic approach, and interest rate term structure may also be incorporated to account for changes in cash flow.
Let us now understand PD modeling using macroeconomic overlay. We have used a very simplistic model based on linear equation wherein past probability of default numbers, unemployment numbers and GDP numbers were used to train the model. The model provides an equation which you can see on bottom of the screen. Subsequently, we have used forecasted GDP and unemployment data which Government of India regularly publishes to arrive at futuristic probability of default data. You can see various boxes from 2025 to 2029 and each box do have some numbers. For example, 2026 PD is 0.0131 and 2029 PD is 0.0148.
Let us now introduce elegant formula for computation of ECL. As you can see on screen, it is sum of multiplication of discounted value of multiplication of EAD, PD and LGD. Each variable in this equation represents a key component of the expected credit loss computation. The discounted factor D converts expected losses at future periods into their present value using the expected or credit adjusted rate.
In this module, we compute the expected credit loss dynamically across multiple time periods. Unlike static provisioning, dynamic computation adjusts based on evolving risk parameters such as probability of default, exposure, loss given default, and discount factors. The total expected credit loss aggregates the period-wise losses and will compute automatically as we process each time period. Now we plot a timeline where each tick represents a time stamp such as a month or a quarter over which credit risk evolves.
For each time period, we calculated expected credit loss using probability of default, exposure at default, loss given default, and discounting. You can notice increase in total ECL on a screen as new boxes gets added. As you go in future, more and more such time periods are added and computation has to be done accordingly. This perfectly demonstrates how ECL will get impacted by changes in economy and life cycle of the asset under consideration. Lifetime ECL in simplistic term mean computation considering lifetime cash flows, and 12-month ECL mean computation based on 12-month cash flows. Dynamic computation of expected credit loss makes provisioning realistic, responsive, and aligned with future expectations. Now we compare difference between IRAC framework and ECL framework. We have plotted columns wherein current provision under IRAC and ECL floor provisions vis-a-vis difference is mapped. You can see maximum difference under farm credit and SME is coming from SMA 1 and 2. Similarly, for commercial real estate also, the delta is coming from SMA 1 and 2. Again, same goes for secured, retail, corporate, and medium enterprise segment. Similar trend is visible under home loans also. Loan against property also continued similar trend, SMA 1 and 2 showing maximum delta. Unsecured retail loans again has similar trend, but SMA 0 also has marginal increase. So overall, stage 1, stage 2 and stage 3. Stage 2 is the area where maximum changes are likely to come in place because the transition takes place from general provision requirement to significant increase in credit risk. To sum up, the 3 ECL stages progress from low to high credit risk. Stage 1 covers standard assets, stage 2 captures significant credit deterioration, and stage 3 represents defaulted exposure requiring full provisioning subject to vintage. The expected credit loss model transforms a static provisioning into a dynamic forward-looking process. It ensures early risk recognition, strengthens overall financial resilience. Let us now understand how ECL is likely to impact on banks' capital position. As per the expected loss framework, regulator has provided floor limits. Therefore, each stage provision is derived under two approaches, the regulatory floor under ECL and the model ECL. The total ECL recognized for accounting and capital purposes is the maximum of these two. Until full implementation, bank will also have to continue computation of IRAC provisions in parallel run. During the transition period, the IRAC provision continues as a parallel floor where total ECL exceeds the IRAC provision. The incremental difference may be phased into common equity tier 1 capital. Banks may add back a portion of this incremental amount to CET1 capital on a phased basis, 80, 60, 40 and 20% over 4 years from 2027 to 2031. ECL implementation will induce maximum change in additional provision due to Stage 2 requirements. Stage 1 and Stage 3 impacts will remain minimal as ECL flow rates and IRAC rates are quite close within this segment. Model ECL is expected to be lower than the floor ECL because of comfortable provision coverage ratio and improved economic conditions. In view of this, delinquency beyond 30 days will create additional cost for banks, and banks may introduce penal measures and tighter collection controls to recover the incremental provisioning impact. To sum up, a bank having larger Stage 2 assets will face higher provisioning requirement compared to one which has lesser Stage 2 assets.
During the video, we explained important aspects of the expected credit loss transition and associated key concepts such as ECL, PD, LGD, and EAD. This concludes the session on the expected credit loss framework. In the next segment, we'll dive deeper into some other topic. Thank you for watching QuantRisk. If you found this helpful, please like, share, and subscribe for more insights on finance, risk, and visualization. QuantRisk, transforming financial learning through visualization.